us in the studio today, the leadership of CEAT. We are now joined by Mr. Arnab Banerjee, who is the MD and CEO at CEAT. Thank you so much, Mr. Banerjee, for joining us in the studio today. We'll be discussing, of course, the industry outlook, auto sales. We are seeing raw material prices, the acquisition that just got completed, Camso acquisition. But first up, thank you so much for joining us on your birthday. It's always a pleasure speaking with you. And since the last time we spoke to you, there's so much that has happened. The GST cuts, that industry turnaround in terms of rate cuts and demand boost. How have you seen things changing as far as demand is concerned? 11% volume growth in Q2. What kind of outlook do you have for the rest of the fiscal and the next year as well?
Well, congratulations on your 26th, first of all, and it's a pleasure to be in the studio after a long time. We always speak virtually, so it's a change for me as well. Coming to your questions, I think, first half has been good. Q2, we had a 5% quarter-on-quarter growth. Q2 usually is a down quarter. September was a degrowth month in replacement because of the GST announcement. So the trade kind of reduced their stock levels. I had mentioned at that point of time that the impact of GST will come slowly in this industry because it's not an item which is bought every day. And we are seeing some early traction, I must say, especially in farm tires and two-wheeler tires, because these are spread over a large class of towns, etc. So we are seeing positive traction in demand, particularly in these two categories, also a little bit in passenger and truck tires. So I think it will be a good impact going forward.
Okay. Mr. Banerjee, thank you very much for joining in and celebrating our 26th milestone birthday. Just wanted to get a sense in terms of where the raw material prices are, because we do understand that they were largely benign last quarter. How exactly are they trending this quarter, and what does that mean in terms of margins for you?
Well, last quarter we had a 5% decline from Q1. So it was a big decline for us. But overall also, if you see the industry, there has been a decline. We think it will kind of moderate to a stable kind of situation in Q3 and Q4, maybe with slight decrease vis-a-vis Q2. But we won't have that kind of a delta again quarter-on-quarter is what we think. So therefore, it's generally positive as far as margin is concerned. Our margins have been 41% in Q2. I had been mentioning that whenever we operate at about 40 to 42% margin, we are comfortable in terms of the whole operating margin as well. So that's come in a good zone. And sales realization is also stable. It's not that the margins, the raw material prices completely going through to the market. So I think 40 to 42% margin is expected going forward.
Okay, so that's about the margin aspect. When you said things are looking good, the replacement part saw some decline in September because of GST impact, but you still saw 11% overall volume growth that came by. What are your targets in FY26, FY27 once the acquisition also is completely coming into your books? You have international markets as well, which contribute to your P&L, and that is not impacted by GST cuts, but other macroeconomic headwinds that we've been seeing. Considering that, do you think you will continue the growth rate that you have seen, or you will do better than that?
Well, our objective is to consistently grow in double digits, and we have been 11-12%. We would like to grow a little bit faster. If you see our value CAGR of the past, it's around 15%. So we would endeavor to beat that kind of a benchmark in the medium to long term, including next year. You are right, international business is a bright spot for us, and before the Camso acquisition, about 19-20% had been coming from international business. Post the Camso acquisition, I believe it will jump straight away to 24-25% and will continue to push this further up because it is value accretive, profit accretive.
And high margin as well?
Yes, absolutely.
Okay. Well, Mr. Banerjee, I just wanted to narrow down a little bit because the MHCV outlook actually, which you've given, is quite interesting. In the replacement demand, you're just about expecting, I think, mid-single-digit growth in the MHCV. And in terms of the OEM demand, you're expecting it to be absolutely flat to maybe 0 to low single-digit. So what's taking place when you talk about demand in the MHCV space?
Well, if you see the long-term demand outlook in MHCV, it generally mirrors the GDP growth, generally, right? And if you see sub-segments, construction is doing well, mining is doing well. And if the GDP growth has been 8% in Q2, and if that kind of trend continues, then mid-single digit is very much possible in replacement market. The OEM demand is cyclical. So it doesn't follow a flattish kind of pattern. So we have seen a down cycle with the GST thing coming up, so on and so forth. Maybe we are a little bit more positive now on the OEM demand on MHCV as well.
But you're concerned about passenger vehicles as a whole, or maybe just in the replacement space?
Replacement market has not expanded adequately in the first half of this year.
Okay.
And with this GST impetus, we expect at least for the smaller tire segments, there will be a positive outlook in the Tier 2, Tier 3 towns, like we have already witnessed for two-wheeler. That kind of trend could come in for passenger as well.
So net, what are you expecting as a whole in terms of replacement demand growth as well as in terms of, say, OEM growth for the second half of the fiscal?
Second half, Jan and February are again low demand months because of onset of winter in north and east. So taking into account the seasonality factor, I would say the outlook is positive from whatever we have mentioned in the past. It could give about 2 to 3% higher growth in second half vis-a-vis first half.
Okay. The other part of the business is balance sheet. You made this acquisition recently. How much would it add to the debt overall? And do you think there are more inorganic growth plans that you have? Maybe in any other space, EV tires, if EV tires for EV segment, is that something that you're looking at and expanding into as well?
First, the balance sheet question. I think we are fairly comfortable in terms of debt equity ratio, which is about 0.6. Debt EBITDA is also 1.5-ish, so very much under control. Debt has gone up by 1,000 crores, quarter 2 on quarter 1, if you see. Our capex guidance is around 1,000 crores for the year. We at this moment stay with that guidance. So everything, even after Camso acquisition, is very much within our operating limits. So that's not an issue at all. Coming to the question of future acquisition possibilities, yes, we will be active in the market, but it's a matter of what is available and what we are interested in and what is our financial muscle at this point of time. But a short answer is yes, we'll be on the lookout of opportunities.
So is there any, you said interesting opportunities, anything specific that you're looking out for? And what's the kitty? With this, how much has gross debt come to, that 1,000 crore addition?
The kitty has to be balanced with our internal growth imperative. With this kind of a growth, double digit, we have to invest in brownfield and later on in greenfield expansion also. So the kitty is not a fixed kitty, it's a dynamic thing. And as we grow, the kitty will swell. So the money will be available. Ratios will be benign, and we will be aggressive for both organic and, if the opportunity permits, for inorganic.
Okay, just quickly before we let you go, what exactly are the inventory levels like as of now, and what are you anticipating in terms of festive demand, if you have to compare it year on year?
Festive demand has just gone by, so the inventories are a little lower than normal. We maintain 26, 27 days of inventory. It's a little lower, but not too much lower. We are operating at about 80% plus capacity utilization in most categories. So you will see a lot of brownfield investments accelerating going forward. And that there will be a regular capex guidance over the next few years for organic growth as well.
Okay, all right. Mr. Banerjee, always a pleasure speaking with you. Thank you so much for joining in today with your thoughts and the outlook going forward. A special day, so good to have special guests in the studio as well.
Thank you very much. 26 years is a great deal of time.
Yes, thank you very much, Mr. Banerjee, for taking the time out and gracing us with your presence. Thanks very much. Well, that is the management of CEAT talking to us. On that note, we need to take a short break. But on the other side, Manisha Gupta is going to be talking commodities. She has with her Sachin Jain, the MD at World Gold Council. Stay tuned.
"26 years of CNBC-TV18